day today. Welcome. I hope that you have a fantastic day today. Today is FOMC meeting, 15th of December 2021. And yes, I have found my, nice suit. I didn't have a tie today, so it was a bow tie today. Hope that you are ready to go. Ready, set, go. Yeah, I know I'm late. So, where are we today? Today we have FOMC. Today we have in 7 minutes, so I'm going to get going pretty fast. We have been expecting this one to be a bullish event. So hope that you can line yourself in there. If you have lined your trade setups in there, or if you have taken profit, or if you have been doing other things that would lay in the side of dollar strength, would then be appreciative. So I hope that you have found your best day today. I hope that you have found your best ways to be commenting today, and that you have brought your big smiles. You have brought your fantastic sides. So what is the currency? What is cyber assets we should prepare for today? Today is not a normal live. I was not live earlier today for other reasons that is not should be mentioned today, but was what it was today. Hardik, I miss you, man. Where are you? Johannes Anderson, hello, Evan. Hi, Johannes. Marlin, hey. Hardik says, let's go. Hoping for dollar weakness. Let's get it. Look very dapper. I guess that is fantastic. Dapper. I don't know what that dapper is. Is that some kind of new language? Then he says hello. Shuran says cool, man. Evan, what's your thoughts on what's going to happen? I think it's going to be dollar strength. Black tie event. Well, it is what it is. Also, I feel like we don't have, as a community, we all have business. We have Forex as a business, but we don't have those, we don't have those parties by the end of the year celebrating our performances, our dedication, our sorrows, and just forgetting whatever has happened and just come together as a community, as a business, as was working together every single day. It is something that I don't see here, so that's why I brought out my nice clothes. Also, we should have had nice food today. I hope you have nice food. If so, I should have given you something to buy nice food, so we all can do nice food. I look like Dunkirky. What are you saying? I'm going to look like I'm going to a quizzed party, and I don't know what that is. I'm going to Google that. So if you're telling me, mister, that is not something great, extremely and beautiful. Okay, thank you very much, Dunkirky. I love that. Andrew Goldie. We will do Goldie. Pound dollar is not one of them today. Pound euro. Euro is there, and then we will add that next to gold. It's here somewhere. Yeah, I know. I'm just trying to make one day out of the year where we are like, well, we should have, not pajamas. And by the way, Hardik, you know my secrets, right? For those who didn't know, I was wearing shorts yesterday, so Hardik knows my secrets. I'm not going to tell you what my secrets are, but yeah, I have secrets as well. Don't worry. That is. Now today kind of celebrates the end of the year kind of a thing. It's kind of end of the year celebration. So for me, it's more like we're coming together here as one of the last times that we're definitely for certain are going to be all of us today So I hope that everyone is here and you have donuts and fancy chocolate chip. I actually had pizza today. That doesn't happen too much. And chocolate pizza for the first time. And I was supposed to be in a very fancy restaurant today. That didn't happen. So, pajamas billionaire there, Denise. Great. Okay, how can we make this one work with all the things that we need to have on this chart, on this screen? Okay, that looks interesting enough to me at least. Okay, well, there we are. And then we add that one, not that one. We need economic calendar somewhere. Economic calendar-ish, I think. Economic calendar and then Fed. Federal Reserve, that's what we need. And then we need that one there. Something like that kind of a thing. Yeah, kind of like that. Where's your Christmas hat? I don't have Christmas hat. Well, I could get some Christmas ears, I would say, guess. Yeah. Investor Invest is also on the pajamas team. Hello from UK. Hello, Ryan. Welcome very much. Where's your Christmas hat? I will find it. If my wife just listens to me, I will go and get it anytime soon. All right, are you ready? It is in, well, 50 seconds left. That is all great. There's not going to be any daily setups today, I think, because that's supposed to be in 30 minutes. So, yeah. Guys, you have comment. Please don't forget to hit the like for this live. So, my prediction is, I think dollar strength. I think that we're going to see increase in dot plot. We're going to see increase in the purchase, the reduction in the QE program. And we're going to see, hopefully, rate hikes for next year. But we shall see. Make sure you have your stop losses ready. So first of all, we're just going to look at what is going to be the interest rates. We are seeing dollar strength. Gold is falling. Euro is going a bit lower. So my thing is all too late. Dollar strength off the books, straight out of the books. 12.30. Gold 17.50 there. We're going to go into this. Why is the market not going to go there? Why is maintenance not working? Did something happen? There we are. We have the report out. Let's go to the report. See your fruitful report. That was not the one that I wanted to go to, but there we are anyways. Euro dollar is falling hard at the moment. Almost no pullback whatsoever. Just a falling hard right now. But let's see if it comes out anytime soon. There it is. No. It doesn't come up on my screen. Does anybody know? Dollar is rising. This is the worst thing I've ever seen in my entire life. It doesn't show up even. Did Fed go down or did my internet go down? That's the question. Fed kept its rate at 0.25. Great. Then we can go to financial juice, I would say, more than anything else. Fed sees inflation at PCE at 2.6 in 2022, previously 2.2. That is an increase. By the end of 2024, 5 of the Fed members expects the rate to be above 2.5%. By 2024, 5 of the Fed 18 members expects Fed funds rate to be at or above 2.5%. Wow! I did not see that one. I did not see that one coming, by the way. I did not see that one coming. Let's see if we can see the statement there finally. I'm close to something. That'll be great. And then we have to open the projections as well. Is it only me that can't? Fed officials expecting 3 rate hikes next year. Interesting. Unbelievable. Is it only me? Can somebody give me feedback on this? Is it only me who can't load it? We'll just take away all of the other things though. But yeah. No, also, yeah, to 2.5 within the next 3 years. Federal Reserve sees economy increasing at 4% in 2023, previously 3.8. That is definitely an increase. That is definitely dollar bullish. 2.2 in 2023 and 2.0 in 2024. With median long-term prediction of 1.8, previously 1.8. Yeah, that's the same. Year-end employment is expected to be at 3.5 in 2022, previously 3.8. 3.5 in 2023, 3.5 in 2024. Medium should be around 4. No change there whatsoever. Only unemployment for 2022 is now revised to be better than previously. So now we are pulling a bit back. We went all the way down to 1.22. Consensus forecast for Fed's fund rate longer run is 2.5, previously 2.5. Okay. Great. Now we have some predictions there. Finally, it's been reported. There, finally I can read it. Okie dokie. So, first of all, we need to read this one, first of all, interestingly fast. So, that is what they always say. There is nothing change here. With the progress of vaccination, strong policy, the indicators have continued to strengthen. The sectors most adversely affected by the pandemic has improved in recent months, but affected by COVID. Job gains has been solid, that is very bullish, and unemployment rate has declined substantially. Supply and demand imbalances related to the pandemic and the reopening of the economy has continued to contribute to elevated levels of inflation. Now, this piece here is very bullish. They're talking about the jobs that has been very solid. They're talking about the employment rate is very good. They're talking about the supply and demand has continued to contribute to inflation, which the reason was why they was thinking that there was a transitionary, because these imbalances that they're talking about, where, for example, goods cannot come to shore fast enough in America, that would lead to higher prices because, there's less products to sell, should be solved by themselves. Now we can see that it's not. Page is down for me, says Happy. I can't even. The website's still loading for Dunkirky. Karim says use interest rates actual. Yeah. Good. Karim, thank you very much. Happy now. Wow. I've not seen such a big spikes in a long time. No, this is a very definitive day, okay? What is different about this day that is different from any other days? Today we are different because we are seeing the Fed changing policy, or expected to change policy in 2022, where we now all of a sudden have rate hikes on the cards. And I was going to look into the projections as well. We can look into the projections here, where they are expecting interest rates that is probably lower there. Unemployment, GDP, PCE, CPE. Here we have the dot plot that we were talking about so many times, okay? In 2021, nobody is thinking of a rate hike. Everybody of the participants in the FOMC is thinking 1 or 2 rate hikes. And now most of them are thinking 3. That is definitely a thing to look out for. As you can see here, I don't know if I remember, as I showed this to A1 Trading VIP group today, the dot plot was a bit of a curve and then exponentially higher longer run. Now it's more of a just a slope higher instead of being an exponential curve. Right now it's just going higher and more in a more timely manner. But still, for 2022, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Can somebody confirm with that with me? 3, 5, 6, 7, 8, 9. So that is probably 9 or 10. Majority think that we should have 3 rate hikes next year. That is a shift and a half on the FOMC. Because I don't know if that is already being updated. As you can see earlier on the dot plot here, I'm just going to bring that up to 1, 2. If my internet allows it, that will always be great. Are they going to increase taper? I need to look into that very fast. Sorry about that. There we go. The dot plot earlier today looked like this, right? Low, low, higher, very high. Now it is way more. Aggressive interest rate hikes. And then we should look into the question that's very important. It is the that is the QE. Yeah, okay, Q. That is, it's not quantitative easing. It's assets percentage. Yeah. The committee decided to reduce the monthly asset purchases by 20 billion of treasury bonds and 10 billion by agency mortgage-backed securities. They went up to 30 billion. Yes, they did. So there were 10 and 5 last time. Now they're going up to 20 and 10 billion. So they are increasing the reduction in their asset purchases, so that now beginning in January and probably also February. Oh, wait, no. Beginning of February, the committee will increase holdings of Treasury by at least 40 billion per month. Of mortgage-backed security, at least 20 and at least 20 billion per month. The committee, by beginning of the month, committee will increase its holdings of Treasury securities by at least 20 billion. Does that mean they're going to buy it again? No. That can't be true. Am I reading something wrong? Is my eyes not working? Yeah. Here we are. Starting mid-January, the Fed will double the present rate of bond tapering, indicating that a comparable rate of reduction will be appropriate in coming months. Yeah. There we are. Then it is an increase. It was 30 billion for... They will increase it to 30 billion. I think that's for January. And then beginning in January, that is probably from February, then they'll go up to 60 billion. The committee judges that similar reduction in the pace of net asset purchases likely will be appropriate each month. Now we need to start calculating here, people. Now we need to start finding our calculators here. So if we can find our calculators, so we started out at 120 minus 15 in November, minus 15 in December. And then we're going up to 30 in January, and then we're going up to 60 in February. So that is 15 plus 15 plus 30 plus 60. That is the end in February. If I read these correctly. So this is really bullish dollar. That's really bullish dollar, yes. Can you explain what bigger than 25 means? Thank you. John Christian, can you tell me in what direction you're talking about that? I think that is that interest rates is going to be greater than 0.25%. But right now the dollar or the America has a target of 0 to 0, 0.000, and a target between 0.0 and 0.25, sorry, percent. I just don't know. If you can send me a photo or something, that will be fantastic to understand what you mean. I do apologize. Text is what makes this different. Another higher taper. Yes, the PPI was 9.6 and 7.7. Why is gold not up? Because that is dollar bullish. Just on what's happened. We have the American Fed said that they are going to increase the net reduction in quantitative easing by $30 billion from February, or from beginning of January. That's probably February. They're going to go up to 60 billion, which is the last month they're going to do that. According to my analysis, that is probably going to make the whole QE end in February. But that's just me. Damn, it's 2 a.m. here. I'm sorry, Halmi. Just curious how the market reacts to FOMC. This was widely expected. We went all the way down to 1220 on Euro USD and has pulled back another 20, 40 pips. Is it 20, 40 pips? Or what is it? Is it just me that is tripling right now? My brain is not working. Yeah, okay. Just 20 pips. Pull back on Euro USD right now. BTC just went up. We can look at BTC in very fast. Sorry about that. Sorry if I'm talking fast. I'm just trying to say what I want to say fast enough so everyone can get what they want to hear. 133 on GU, 113.50 on EU. There you go. I told you to sell, so going down to 110 and 130 respectively on Euro. Investor has a target on Euro at 110 and 130 on pound dollar. Yep, the math is correct. The indices are green already. Yes. That is also indication of I am saying dollar bullishness, Hardik. You should have. Sorry, I guess you haven't been on my lives lately. Gold went down hard. Now it's up again. It's just a pullback, my friend. By all means, this is just a pullback. So BTC up is probably good for someone, but if you look at the gold right now, and I can't load gold at the moment, so we're just going to go to another gold because we can't load gold. Gold is coming back hard. So that is kind of what you are expecting out of an FOMC meeting, is that something that goes down might actually also come back up again. I do apologize for that, but it is what it is. Euro dollar still red. Aussie dollar is actually green for some reason. Pound dollar, another great fall to 31.70. And pound yen is going to the upside here. Why, you might ask? Because this is a dollar move by all means. By all means, it's a dollar move. So I still haven't got this one above 151.20 either ways. So I'm still waiting for my bullish run on pound yen here. Should gold go down if dollar goes up? Yes, lol. Nanmas, can you share my FX book link again? Can you share your my FX book link again for the FX Pro account? That's probably one of the worst performing account that I've had in recent years. I am 10% down, and I have no trades open at the moment, at least on that one. So yeah, I just need to get back at it, I guess. But yeah, there you go, 10% down on a $250 account. I still haven't smashed it, but there you go, great. Pound yen, dollar yen is probably one of the better ones today. They will wait for the labor market to reach maximum employment before rate hiking. Yes, but I can also expect that can also happen next year. So what to kind of mention to you guys here, just to clear things up a bit, is that dollar, with expecting of increase at some point in the future, should rise. Now there is a whipsaw around at the moment around dollar. That is to be expected. But even though if it falls today, I told someone today that 96.10, or yesterday I think also told the mentorship students, 96.10 is the level to think about. So if you are at 96.7 right now, we are well above 96.10. So 96.10 is my bottom, where I'm like, is this bullish or is this bearish? So really, you should really be, that's where you should be worried, not really what happened to gold at this meeting here. And if we broke below 96, then I would get worried. Right now, we're going higher. We're having a pullback. You are getting entries. Imagine that. You're getting entries to buy more dollar. Have fun with it. USD, how will this impact oil? I haven't come to think through it though. BTC looks ripe for a short at highs. Yes, do so. So let us go through something here, everyone. Okay. I hope that my analysis of dollar strength is because we are seeing potential rate hikes next year. Now it is confirmed that the Fed members also think we should have rate hikes next year. I think that deserves a like on this stream. We are 102 people right now. We were 102. And I want you to come back and say, thank you for that knowledge. I came to your live and I learned something new, or something that I probably didn't think about. The other thing is, if gold now goes up again, did you buy in this highly volatile market? Well, that is definitely your case. I wouldn't buy gold right now. I wouldn't be close to in a buy position right now, because we just made a lower low down to 1752. That is definitely bearish. Though we're having a pullback, that is just someone's pullback coming in here, and they are just giving it to you for a better price, so you can sell it again at a better day. Oil is going up, says Denise. I can look into oil. Oil, should this be positive for oil? It should be positive for oil in the long run, at least. But I haven't really done the analysis there. I haven't really thought about it. I haven't really thought it through, to be honest. So, yeah, basically. Okay. I'm new here, Ryan. Yeah. Thank you very much, Ryan. I will try my absolute best to explain whatever I say twice in a more interesting manner. Okay? So, what are we expecting now? We are waiting for the FOMC. Sorry for Powell to come out and speak in 10 minutes. We are also expecting the market to cool a bit down to get all the information in and price that in. But I think that what you should be focusing on, what does this mean for your trading? This means for your trading that you should look out for dollar bullish strength and only trade dollar strength moves more than looking for those short opportunities. Maybe we have dollar strength a bit early this year, and Santa comes a bit early this year, but is that I'm expecting dollar strength back over in January. So I don't know if I'm going to get that this year or if you're having that right now. But just remember that we were supposed to be dollar bearishness seasonality-wise, and there's still people trying to sell the dollar, but this at least solidifies 2022, at least the first half of 2022, at this given time, as we stand today, to become dollar bullish. Now, what do you think retail traders are doing at this moment? Those I want you not to be a part of. I want you to be an expert. I want you to be knowledgeable. I want you to make analysis before you go to the charts. You look at where does the Fed want the market to go. That is what they effectively are doing. Quote unquote, manipulating the market into what they want them to do. by reducing now supply of money, by taking away that supply that we're giving to the market and saying, hey, you will figure yourself out, okay? So when the supply came in March 2020, we saw a dollar falling. Now we are seeing dollar rising. Why do we see dollar rising? Because we are seeing a prospect of higher interest rates. You as an investor holding dollar will then get more and more paid as interest rates in America increases. Not yet though. And you would then see more and more reductions in euro, in Aussie, in pound, in New Zealand, because whoever gets to set the tone of increasing interest rates, whoever gets to be the best economy will win the most appreciation. So if you then think that this will make Aussie, Euro, New Zealand strength, I do apologize. That might not happen. Well, from now and 3 months out, we're going to have strengthening. We are going to have weaknesses. We are going to have trends. But yeah, I was on a ride there. Rosanna says, work tech. I don't know what that means, but okay. Orlando says, I'm trying to figure out this market taking a hit or not. I have a put on Apple, lol. This isn't positive for the market short while. So you might see the market falling a bit here and there. I don't know if it's 5%, I don't know if it's 10%, but generally this explains or profits, or this one reflects a strong economic performance in America. Okay? Good. I could beat myself up for not holding my S&P 500 and DAX positions from earlier this day. Now everything is greener than my garden. That's a good one. Crypto says, do you want to hear a joke? I can read a joke. I got a good joke. Who want to hear it? Me. It is her dirt. Okay, I can. Also says me. Dollar strength. Okay. I'm throwing the towel. I am buying dollar now. Yeah, I have thrown down the towel as well, Anne. Why would you want to buy the only asset in the world that cannot go up but only goes down? Why would you want to buy the only asset in the world that cannot go up and only go down? Dollar is not rising. In reality, it's called inflation. How could the dollar be rising if Chipotle cost 20% more than last year? It is falling as it always does. Then he says, what about people taking profit on dollar longs at the end of the year close? It is people taking dollar long. Well, that would only create an opportunity to buy it at a better price. So that's what I'm saying, Denny, is that we might have some bearish short-term trends on dollar that will enable us to buy at a better price. But I'm scared. I'm not scared, but my theory, plan B, C, D, Z, is that strength happens now and weakness happens in January instead. Lul asks, are we going to watch the stream from the Fed in this stream? Absolutely, yes. We are going to watch the stream. We're going to watch Mr. Jerome Powell, our Forex god. We're just going to find him from... Not that one. Where is he right now? Fed? Probably. Where is his federal... Huh? Where is it? Where's the channel? Okay, no. Then we have to search for Federal Reserve. There they are. Jeez. And help us God. I need to check the sounds. That's a bit much. I hate that sound, by the way. But yeah. So we have 3 minutes left to that one. I know that was coming. Who said that? Happy day. Did you say what did you say? Happy day. I need to go to live chat instead because that's apparently more up to date. Stroller strength is the biggest joke of all time. So okay, great. Is crypto Zard bullish on dollar? I don't know. Do you have a plan A to Z, Dunkirky? Yes, I have. Okay, I take that back. S&P 500 is now falling. I will stay tuned for the live stream too. Yeah, it's in 3 minutes. Thanks for the contract. Yeah, I probably should have done that, but yeah, but never late than ever. Better late than ever. Yeah, something like that. So Meet Kevin is live now. Yeah. Okay, good. So we only have 40 likes today out of 90 people watching. Okay. Well, I'm not going to mention that anymore. I do apologize for that. I'm not going to do that anymore. I am going to make you feel like I will make myself earned. That's what I will do. Euro is finally now trying to make a rollover. It gave you a pullback. That's what I'm going to tell you. Hello, Erdo. Yeah, there is no daily setups today. However, says, thank you guys. Thank you for whoever called out BTC. I think it was David or something like that. Keenan says, like a train. Like a train. But yeah, I wouldn't say that bullishness on Mr. On BTC was fantastic though, but I guess it goes. And if you want a more fundamental analysis, if you want a more trading on the 15 minutes, if you want trading on longer term and making money longer term, more than one day, this is a channel for you. I try to explain why the market moves and not just technically where I buy and where I sell. Well, I hope it starts anytime soon. That would probably be great. That doesn't hurt. Didn't even take it. I was a noob waiting for a close. Yeah, probably. Sorry about that.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept interest rates near zero and updated its assessment of the progress that the economy has made toward the criteria specified in the committee's forward guidance for interest rates. In addition, in light of the strengthening labor market and elevated inflation pressures, we decided to speed up the reductions in our asset purchases. As I will explain, economic developments and changes in the outlook warrant this evolution of monetary policy, which will continue to provide appropriate support for the economy. Economic activity is on track to expand at a robust pace this year, reflecting progress on vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continue to foresee rapid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 5.5% this year and 4% next year. Amid improving labor market conditions and very strong demand for workers, the economy has been making rapid progress toward maximum employment. Job gains have been solid in recent months, averaging 378,000 per month over the last 3 months. The unemployment rate has declined substantially, falling 0.6 of a percentage point since our last meeting and reaching 4.2% in November. The recent improvements in labor market conditions have narrowed the differences in employment across groups, especially for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor force participation showed a welcome rise in November, but remains subdued, in part reflecting the aging of the population and retirements. In addition, some who otherwise would be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. At the same time, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. How long the labor shortages will persist is unclear, particularly if additional waves of the virus occur. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate declining to 3.5% by the end of the year. Compared with the projections made in September, participants have revised their unemployment rate projections noticeably lower for this year and next. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. As a result, overall inflation is running well above our 2% longer run goal and will likely continue to do so well into next year. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, but thus far, wage growth has not been a major contributor to the elevated levels of inflation. We are attentive to the risks that persistent real wage growth in excess of productivity could put to upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline to levels closer to our 2% longer run goal by the end of next year. The median inflation projection of FOMC participants falls from 5.3% this year to 2.6% next year. This trajectory is notably higher than projected in September. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials, like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market, and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee reaffirmed the 0 to 1/4% target range for the federal funds rate. We also updated our assessment of the progress the economy has made toward the criteria specified in our forward guidance for the federal funds rate. With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment. All FOMC participants forecast that this remaining test will be met next year. The median projection for the appropriate level of the federal funds rate is 0.9% at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its longer run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases. Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November. We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support. In addition, a quicker conclusion of our asset purchases will better position policy to address the full range of plausible economic outcomes. We remain prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to foster accommodative financial conditions. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you, Mr. Chair. We'll go to Rachel from the Washington Post.
Thank you very much, Michelle, and thank you.
He didn't say anything new, by the way.
The latest FOMC materials say that the FOMC thinks it will be appropriate to keep rates near zero until labor market conditions reach levels consistent with maximum employment. And there are also 3 rate hikes penciled in the projections for next year. In order to set up those hikes, what will maximum employment have to look like? When will you know that that threshold has been met? And how will that be communicated? Thank you.
So maximum employment, if you look at our statement of longer run goals and monetary policy strategy, maximum employment is something that we look at a broad range of indicators. And those would include, of course, things like the unemployment rate, the labor force participation rate, job openings, wages, flows in and out of the labor force and various parts of the labor force. We'd also tend to look broadly and inclusively at different demographic groups and not just at the headline and aggregate numbers. So that's a judgment for the committee to make. The committee will make a judgment that we've achieved labor market conditions consistent with maximum employment. When it makes that, it is admittedly a judgment call because it's a range of factors. Unlike inflation, where we have one number that sort of dominates, it's a broad range of things. So as I mentioned in my opening remarks, in my view, we are making rapid progress toward maximum employment. And you see that, of course, in some of the factors that I mentioned.
Great. Thank you. Steve at CNBC.
Thank you, Mr. Chairman. My question is, if it's often said that monetary policy has long and variable lags, how does continuing to buy assets now, even though it's at a slower pace, address the current inflation problem? Won't the impact of today's changes not really have any impact for 6 months or a year down the road on the current inflation problem? And aren't you actually lengthening that time by continuing to buy assets such that it could be not until the long and variable lag after you end purchases sometime in March that you'll start to have any impact on the inflation problem?
So on the first part of your question, which is why not stop purchasing now, I would just say this. We've learned that in dealing with balance sheet issues, we've learned that it's best to take a careful, sort of methodical approach to make adjustments. Markets can be sensitive to it, and we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go. So we announced it, and that's what will happen. The question of long and variable lags is an interesting one. That's Milton Friedman's famous statement, and I do think that in this world where where the global financial markets are connected together, financial conditions can change very quickly. And my own sense is that they get into financial conditions affect the economy fairly rapidly, longer than the traditional thought of a year or 18 months, shorter than that rather. But in addition, when we communicate about what we're going to do, the markets move immediately to that. So financial conditions are changing to reflect, the forecast that we made, and basically, which was I think fairly in line with what markets were expecting. But financial conditions don't wait to change until things actually happen. They change on the expectation of things happening. So I don't think it's a question of having to wait.
Can I just follow up in thinking about having to wait? Is it still the policy or the position of the committee that you will not raise rates until the taper is complete? Thank you.
Yes, the sense of that, of course, being that buying assets is adding accommodation and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected, I think if we wanted to lift off before then you would stop the taper potentially sooner. But it's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Okay, let's go to Colby at the FT.
Thank you, Michelle. Chair Powell, I'm curious exactly how much distance you think there should be between the end of the taper and the first interest rate increase. Back in 2014, the guidance that was given was for the Fed funds rate to remain at the target level.
He said that the QE program should end in March 2022.
The current economic situation warrants something a bit different. Thank you.
So we haven't made any decision of that nature, and so no, I wouldn't say that's our position at all. We really haven't taken a position on that. I will say that we did talk today. We had our first discussion about the balance sheet, for example, and we went through the way the sequence of events regarding the runoff and that sort of thing with the balance sheet last time. And I think people thought that was an interesting discussion. They thought that it was informative, but people pointed out that this is a significantly different economic situation that we have at the current time, and that the differences that we see now would tend to influence how we think about the balance sheet. And the same thing would be true about raising rates. I don't foresee that there would be that kind of very extended wait at this time. The economy is so much stronger. I was here at the Fed when we lifted off the last time, and the economy is so much stronger now. It's so much closer to full employment. Inflation is running well above target, and growth is well above potential. There wouldn't be the need for that kind of long delay. Having said that, we'll make this decision in coming meetings, and it's not a decision that the committee has really focused on yet.
Let's go to Nick at the Wall Street Journal.
Thank you. Nick Temeros at the Wall Street Journal. Chair Powell, in March, you answered a question about maximum employment like this. You said 4% would be a nice unemployment rate to get to, but it'll take more than that to get to maximum employment. More recently, you have hinted at a possible distinction between the level of maximum employment that's achievable in the short run versus in the long run. Has your view of the level of maximum employment changed this year, and if so, how? And how close is the economy right now to your judgment of the short run level of maximum employment? Thank you.
Right. So the thing is, we're not going back to the same economy we had in February of 2020, and I think early on the sense was that's where we were headed. The post-pandemic labor market and the economy in general will be different, and the maximum level of employment that's consistent with price stability evolves over time within a business cycle and over a longer period, in part reflecting evolution of the factors that affect labor supply, including those related to the pandemic. So I would say, look, we're at 4.2% now, and the unemployment rate has been dropping very quickly. So we're already in the vicinity of 4%. The way in which the important metric that has been disappointing really has been labor force participation, of course, where we had widely thought, I had certainly thought that last fall, as unemployment insurance ran off, as vaccinations increased, as schools reopened, that we would see a significant surge, if you will, or at least a surge in labor force participation. So we've begun to see some improvement. We certainly welcome the 0.2 improvement that we got in the November report, but I do think that it feels likely now that the return to higher participation is going to take longer. And in fact, that's been the pattern in past cycles, that labor force participation has tended to recover in the wake of a strong recovery in unemployment, which is what we're getting right now. So it could well have been that this cycle was different because of the short nature of it and the very strong, the number of job openings, for example. You would have thought that that would have pulled people back in, but really it's the pandemic, it's a range of factors, but the reality is we don't have a strong labor force participation recovery yet, and we may not have it for some time. At the same time, we have to make policy now, and inflation is well above target. So this is something we need to take into account.
If I could follow up, you've talked recently about risk management, and so does that mean that the committee might feel compelled to raise interest rates before you're convinced that you've achieved the employment test in your forward guidance?
So this is not at all a decision that the committee has made, but you're really asking a question about how our framework works. And yes, there's a provision, what used to be called the balanced approach provision, that says in effect that in situations in which the pursuit of the maximum employment goal and the price stability goal are not complementary, we have to take account of the distance from the goal and the speed at which we're approaching it. And so that is in effect an off-ramp which could, in concept, be taken, and it's in our framework. It's been in our framework a long time. I've talked about it on a number of occasions. It is a provision that would enable us to, in this case, because of high inflation, move before achieving maximum employment. Now, as I said, we're making rapid progress toward maximum employment in my thinking, in my opinion, and I don't at all know that we'll have to invoke that paragraph. But just as a factual matter, that is part of our framework and has been really for a very long time.
Thank you.
Thanks. We'll go to Howard at Reuters.
Thanks, as usual. So I guess I got to ask about the elephant in the room, which is the Omicron variant. This seems to already be pushing one of your colleagues, the Bank of England, off its course. Things have evolved very fast there. Hasn't quite hit the shores of the U.S. in full force yet, but people seem to expect it to. So I'm wondering, in your feelings about this, are you convinced that this is going to be perhaps a more infectious but less serious variant of the virus, or are you simply confident that the U.S. economy can continue its divorce from the pandemic?
Well, I think there's a lot of uncertainty, which is why we called it out in our statement, our post-meeting statement, as a risk. We follow the same experts, and we talk privately to the same experts that everyone else does, and read the same articles in the paper and the same research. And so you mentioned the early assessment is highly transmissible, perhaps not as severe, some continuing protection from existing vaccines and also existing immunity from having had the disease. That's a first draft. We're a long way from knowing what it will turn out to be. It may well come to the United States and replace Delta as the dominant variant fairly quickly. That could easily happen. I think there's another step there, though, which is what's going to be the effect on the economy, and that will depend, on how much it suppresses demand as opposed to suppressing supply. It is not clear how big the effects would be on either inflation or growth or hiring. On top of what's already going on, which is quite a strong, wave of Delta that's hitting large parts of the country across the northern United States and all the way to the eastern seaboard, and now coming down. We're having quite a wave of Delta. So coming in on top of that, again, it's very difficult to say what the economic effects would be. I do think wave upon wave, people are learning to live with this. More and more people are getting vaccinated. So people who get the new variant, it affects them much less than it tends to affect in the aggregate people who are not vaccinated. So the more people get vaccinated, the less the economic effect. It won't have an economic effect. Delta had an effect of slowing down hiring, and it actually it had an effect on global supply chains, and that hurt the process of the global supply chains getting worked out. So it can have an economic effect. I just think at this point we don't know much. We'll know a whole lot more in 3 weeks, and we'll know more than that in 6 weeks.
But if I could follow up, you're clearly from a sort of from a risk standpoint comfortable putting away one of your tools pretty soon, which sort of implies that whatever Omicron brings, you're comfortable the economy can handle it without quantitative easing.
Yes. Yes, I think if you look at the state of the economy, inflation, look at wages, I think moving forward the end of our taper by a few months is really an appropriate thing to do, and I think really Omicron doesn't really have much to do with that.
Thank you.
Let's go to Gina at the New York Times.
Hey, Chair Powell. Thanks for taking our questions. I wonder if you could talk a little bit about what prompted your recent pivot toward greater wariness around inflation.
Sure. So I guess I would go back and, it's been a continual process, really. Inflation really popped up right in the late spring last year. And we had a view, it was very, very widely held in the forecasting community, that this would be temporary. It was quite narrow. A limited number of factors were causing it. And there was a decent amount of evidence to support that view that it would be temporary or transitory, as we said. Certainly, we had 5 months of declining month-on-month, monthly readings of inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we.
All right. What's going on, mate? What's happening? What's cooking? All right. So let's go through the market then. Hope you guys like my outfit today. Next time I'm probably going to do a t-shirt and shorts, but yeah, just for the fun of it. But so dollar. Oh, okay, guacamole. That's a lot of guacamole there. As I earlier said, I am still expecting market to hold 96.10. Now that we are pulling back, that makes me a bit. I'm not really happy about this one though, but I guess it is what it is. Market went up to a high, has now stopped. I think this might be the weekly target. Yep, that is. That is why we are can also be the reason why you're falling. Why dollar is falling is a bit understandable for me, but it is the risk, I guess. Nasdaq is finally higher again. S&P 500 is also in the green. I saw Happy was not happy about his positions up and down. I do apologize for that, but this can potentially send the stock market lower. Short term, and then long term should go higher again. But yeah. Yeah, so you guys are just talking about what? So Aussie has not made a higher high yet. Coming up to another 75.50 area, we still haven't seen the sell price this week, which is this price around 71.79. What does that mean? That means this high is still being respected. This is still being respected to the lower side. Now, what is going to happen next is up to the market. And then you're going to if-then statement. If market starts going higher, you get out. But don't be a chicken if you have sold it, okay? Don't be a chicken if you have sold Aussie dollar. Go to your stop loss, Have your stop loss above where you're supposed to have. Follow your trade plan. Don't be a chicken. I'm not saying you should have extraordinary losses just because I say that. You should have normal losses like 1% and stop losses should be above here. All right, good. Next, euro. Have a pullback in a range. Nothing is particularly happening here. We went down to 120, well, like 1220, and then what? We didn't make a lower low, and then what? We are ranging, then what? Tell me. We have not broken above 1320, so we are still bearish, even though we have a red or green candle. Still bearish. So, what does that mean for you? That means for you to either you can add sells in whatever the resistance areas you have found. You're still very much allowed to sell where you are supposed to sell. Now, will that come through as fruitful trading? I don't know. I didn't do it. I'm not going to force the market. The market is doing its thing at this moment. Right now, the market is doing its thing. I don't know what's going to do next. Is it going to go higher? Is it going to go lower? We have broken a bit lower than what the Fed, where Jerome Powell said we were going to go away from transitionary. That went away. And now we have got some clearance. I guess, I don't know what this is supposed to be about. I want us to be down here. So up right now, I'm just taking into consideration that, yes, we are pulling a bit back. The pound dollar still has resistance at 32.80. Still not broken. Until it's broken, then we can discuss it more next. Okay. I don't think that Jay Powell is as hawkish as market may have priced in. That is a very good reason there, Mr. Tang Huang. Why would you be dollar bear? Dollar news is bullish. We all have different reasons for what. Thing is, crypto rich says the economy is just a pure bubble, and this COVID is just an economic virus. Okay. Thank you for your comment, Abbas. We needed better price to see sentiment of retailers to sell the bottom, buy above, and then clean them out back down again. Nat gas. Will rate hikes weaken dollar? Nope. Not in the beginning, at least. Aussie dollar. No, gold next. So, what is retailers doing? So, first of all, retailers was washed out here if they bought pound dollar. Retailers were washed out here if they bought euro. And they were washed out here if they bought Aussie. And we all know that they are dollar bear. Retailers that 90% of the time loses 90% of the money within 90 days has sold the dollar. So, pound yen still not a bullish trend, but this is positive at least to the upside. That's great. Maybe we shall in the end get a trend higher. I don't know, but I wanted to go higher, but I don't see that yet. New Zealand dollar, we had a low here. So for the past days, we have been selling New Zealand dollar there, New Zealand dollar there. And then right now, you are getting a same price as earlier today. Congratulations. So we are still seeing a bearish trend. What is the target, you might ask, for this week? It is already been hit. That's why I say the market's having a pullback. They already took profit on their dollar bullish moves. Okay? On euro? Nope. Aussie? Nope. But New Zealand, pound didn't. Aussie did not either. So only New Zealand did take profit for the week. USD CAD, on the other hand, also took profit for the week. That's why you might see some USD CAD fall. By the way, I said USD CAD up this week. Boom. Have fun with that one. So, Ryan, What did you find on my channel? Is it fun to be here? Though I haven't said any jokes yet. I haven't been off the charts yet, and I normally tell jokes. Yesterday, me, Harold, and Harold, that is here, and also another guy, we were chatting for an hour on Zoom, and telling each other very funny jokes. I'm not going to tell the jokes because they don't fit on this channel, but they were inappropriate. If you like Eivind's looks or dress today, I'm not having a dress, it's a suit. Okay, you guys are just having fun with me today. So you see, and then take off that one. It's a time for tell me a joke. Okay, I'm just going to take off my suit. Oh, okay. My cable is stuck somewhere here. Son, what? There we are. There we are off. And then probably have to take that one behind there. Let's see if that fits. That fits. Uh-huh. And then everything up like that. Son. Now I look like Dracula. Harold, do you have any jokes? I can't think of one, by the way. Why can't I think of one? Is because I don't know which one I should think about. Sonda. Now. Is that better? Too much chest. Sorry, that was the wrong one. So too much chest. My trades are down. I can't sleep. Sorry, lol. Till this pullback ends, I'm gonna go to sleep. It's only 5 a.m. Yeah, I've been up to 5 a.m. talking jokes and fun to resume meeting people as well. Harsh Patel asks about oil. I think it should go higher in the end. I don't know if it should go today. What's the word? What's the word for foreplay in French? There isn't one. Okay. I thought that French, you know, when you go to France, you go to foreplay, you know, you're romantic, you give them good wine, you give them good chocolate. Yen pairs seems to be responding by selling yens, by all means, but I didn't expect that one to come. USD yen should probably be the best one today. Okay. Still in the green there. Yen pairs, I think I need to come back to these ones because Okay. Natgas is currently range bound at the bottom. Somebody subscribe. TJ Smith just subscribed to your channel. Thank you very much. Yeah. I only have dark jokes in my head right now, or naughty jokes. So I don't know if there's any good one out there that I can tell. I will be appreciated. Do you remember any of my good one, Harold? I probably have some good ones. I just don't remember. If they are TV friendly. That's all. Silver is coming up higher now. Gold is coming higher. I want this to rise. I'm not saying that it should fall. I don't want it to fall, by the way. But that's kind of where things is going at the moment. Seems like I am downtown at the moment on Aussie. Okay. But Interesting. Have we waited until now to go dollar bearish? Have we waited until now to go dollar bearish? Well, at least those pairs are definitely on the lower side, and I'm baffled. At the moment, actually. The French gets right down to business. What did the cheese say to itself in the mirror? Hello, me. That's probably an English joke. Why couldn't... Well, here is my joke, okay? Here's my joke. Okay, here we are. Why couldn't the toilet paper cross the road? Because it got stuck in a crack. Keenan has an interesting comment here. You said the news isn't bearish. Why is dollar then rising? Have you changed your mind? I have not changed my mind at all. I think this is going to create dollar bullishness. I don't know what the short-term outlook is going to be. But that's why you have your stop loss, right? I'm not going to change my outlook. I'm not going to change my view. I'm not going to change what I said because I'm still going there. So, you know, it's still there. Even though dollar weakness now, and I said 91.10, I'm not even thinking about it being bearish. I'm not even scared about it being bearish. I see the pullbacks, but if it hits my stop loss, then so what? Two penis walking down the road. One was one was assaulted. If Jazz is here, I will try to remind him of try that one again. So dollar pairs, I went through them and I'm going to go through them again. That didn't hold, then okay. 71.80 is still there, 71.17 is still there. Fair enough. Euro, nothing has changed. This is not bullish. It just has a pullback. Then so what? I can still survive this easily. Pound dollar has a pullback. Is it bullish? No. This is not bullish. It has a pullback. Yes. Has it broken out? No. Can you buy it? Probably not, because this doesn't fit any books. This doesn't fit any buyers in my book. Is this New Zealand dollar bullish? No. Does it have a pullback? Yes. Has you sold it? I don't know. That's up to you. It's coming back to resistance. But if it does go higher and goes up here, then so what? Your trading shouldn't be based upon one volatility event kicking out like a retail trader cannot trade. You either have something wrong with your entry, something wrong with your trading, something wrong with your risk, something wrong with something of what you're doing, and I beg you to start changing that absolutely right now. Um, 91.60, and we are not even close to 91.60 on dollar. Okay. Gold has now are now rising. It fell, now is rising. Then okay. Are you out of stop loss at break even? Are you out at your 1%? If you try to sell gold, Okay, good. If you try to buy gold, I'm not going to call you a useless piece of trader, but I am still not able to buy it. And I still haven't lost a single penny on gold in December because there hasn't been a bullish trend yet. All right? I don't know how far we're going to go. I do apologize. I do know how far we're going to go. I want this to be at 73. Then I can start buying it. I still haven't lost any money to oil in December. Right? So that's kind of that. So I think we're going to go end with that. And then we're going to cut back another day. I am not going to be live tomorrow. I'm probably not going to be live on Friday either. So I'm probably going to see you on the weekend. Hopefully you will have got some news out today is that we are increasing our bond purchases. Dollar is falling. Then that was against what I wanted to see. I'm not always right. I'm sorry. Pound yen has crossed past what I wanted to see. Maybe there is something there tomorrow. Who knows? Take care. Have a good night. I see you another day. And we'll trade forever for the next 20 years. This shouldn't be the day where you quit trading.